Welcome to lecture number 20. So, we have started with zero knowledge in accounts. Now, we have traversed around 5-6 hours of intensive learning and then revisions. Now, we have come to the lecture number 20. By this time, I am pretty sure each one of you has got hold of accounts and also how to convert financial transaction into P&L and balance sheet through double entry system, meaning of P&L and balance sheet double entry system, and also prudent principle of the accounting, fundamental principle of finance, and that how the revenue jack-up, etc. happens, and then how the manipulation of accounts will happen. So you are pretty comfortable with the accounts. And I can say, yes, you have built up above average knowledge in accounts up to now. Because now I'm pretty sure you've got complete clarity what is the meaning of the accounts and etc. Before we go to application of these numbers in financial decisions, like ratio analysis, cash flow analysis, capital budgeting, capital planning, let me again sum it up with the individual item of profit and loss and balance sheet and show it to you some of the real pictures of the accounts. Here also we shall use the Reliance Industries Limited, the balance sheet we shall use. So here, what is our purpose here? To slight kind of repetitions or some kind of revision, I will say, not repetition, revisions, to understand what is the different meaning of P&L and balance sheet and how we can correlate our picture, what we have discussed, with the actual picture which we will get in the P&L and balance sheet. Main principle remains same, but it is always better if you can see in front of your eyes the actual picture and how we can correlate, then subsequently we can pick it up. Now, in the balance sheet, we have segregate this balance sheet equity and liability into three parts. First, equity, then non-current liability and current liability. Non-current liability and current liability is called total outside liability. It's a borrowing in the form of a debt. Similarly, asset side, what we have, two parts. It is a current assets and the entire amount is non-current assets. But here non-current assets is shown in fixed assets and non-current assets. Now, if I look at it, what is the meaning of equity? Now, in the case of an equity, we have something called capital. Capital means entity raises the money by issuing shares. So if an entity, so Reliance Industries Limited, is raising the money by issuing shares, the entity at the time of issuance is not providing any commitment to the shareholders that it will give certain return. It says that in case profit happens, then it will keep the return and the return is not pre-decided. Now, capital is also are of two types. One is called the ordinary share capital. One is called the ordinary share capital. Under this, what happens? Issuing entity is not committing any fixed return. Once the entity earns profit and fulfills its commitment to others, money will be paid by the entity to its shareholders. This is called the residual rights. Why residual rights? Now, the entity will borrow not only in the form of equity, but non-current liability and current liability. So after meeting their commitment, whatever is left, it will give it to the ordinary shareholders. Since whatever is left, that's a residue, that is the residual part. That is the residue, what is left is called residue. So that is, it is called residual rights. There's another category of share is there, which is called preference share capital. Now, preference share capital means at the time of issuance, the issuing entity is telling that if I earn profit, at what rate I will go, it is predetermined. So in this case, what is this part? That if I earn profit, at what rate I will pay it to you, that is called the preference shares. So preference shares would be paid first and then ordinary share capital would be first. Next, under the equity head, you will get something called reserves and surplus. In the reserves and surplus, you have something called general reserves. Profit earned over a period of operation of this entity is transferred to general reserves. Entity can use this for general purposes. How it is coming? If you can correlate from P&L, the profit of a particular is transferred it to the retained earning. In our example, we have shown it as a retained earning. So here, equity capital plus retained earning taken together is called equity. So under equity capital, I have mentioned. Now, under retained earning, the reserves and surplus will come. Under these general reserves, it will come. Now, there is something called security premium. What is security premium? If a share which face value is 10 issued at 40, so additional 30, which is the company is getting, will be captured under the head security premium. So it would be coming under reserves and surplus. Another part is debenture redemption reserves. If an entity has raised some money in the form of a debenture, we will come slightly later on, then it has to set aside from each year's profit a certain amount, which would be going to the debenture redemption reserves. Then revaluation reserves. Suppose an entity is having an asset, which is original value is 20 crores. Now, because of the market, suppose it has acquired that asset 50 years back. Now, because of the market, the value has become 200 crores. So 180 crores increase has to take place, because in the asset side, 180 crores increase is happening. So on the liability side, it will come 180 crores increase will come in the form of a revaluation reserves. Revaluation amount will be booked in this head. Now, what does equity and reserves and surplus means, or equity means? Equity means capital plus reserves and surplus. It means that the entity has got the flexibility of repayment. So if it does not earn profit, it will not make the payment. It is no firm commitment. So since it has the flexibility of repayment. The next important part, if I look at non-current liability. As we have mentioned, non-current liability is a borrowing. Borrowing means the entity has to give a firm commitment that whether it is earning a profit or not, it has to make the payment, that also at a predetermined rate. So in this case, the debenture, in the case of the non-current liability, first is debenture. Entity issues debenture securities and the entity commits that it will make the payment of interest and principal irrespective of earning or not. So this is called debenture. Convertibles. A convertible is another kind of instrument. This is also called hybrid instrument. Why hybrid instrument? Under this, the entity first issues a debt securities like debenture. Suppose entity is issuing a fully convertible debenture of say 100 rupees face value, where it says first 3 years it will pay an interest rate of 9%. And after 3 years, whatever the debenture outstanding is there, that would be converted into equity at a price of say 30 rupees. So in this case, if the entity has issued a debenture of 120 rupees worth of debenture, so it will make a payment of say 6%, that is the coupon, for the next 3 years. Suppose it is issuing a debenture of 120 rupees and it is promising that it will pay an interest. The interest payment of debenture is called coupon for 6% for 3 years. So it will pay 120 into 6% in 7.2, 7.2, 7.2 in 3 years. After that, it will be converted into 4 equity shares of 30 rupees value. So why? Because 30 rupees value for one share, 120 outstanding divided by 34 shares. So this is called convertible. Now why it is an hybrid? It is a mixture of both debt and equity. Term loan, under this, the issuing entity is committing to make a payment of principal and interest irrespective of the predefined schedule, whether it is actually earning profit or not. Now, when you talk about the term loan and debenture, what are the types? First is the secured. That means when a company is issuing a debenture, it can be secured debenture, it can be unsecured debenture. Or when it is raising a term loan, it can be secured term loan, it can be unsecured term loan. What is the meaning of secured debenture or secured term loan? In case the company fails to make the payment, the lender can take the asset and it can sell it off and recover the money. That is called secured debenture. Suppose I am a company, I am raising 20 crores. Against that, I have given my office. Now, in this case, if I fail to pay, that particular lender can take the office and then they can sell it off. So this is called the secured debenture or secured term loan. You have seen recently Jet Airways office is being sold by the lender. So that is an important part. We have to keep it in mind. What is an unsecured debenture or term loan? In the case of an unsecured debenture and term loan, the lender cannot take any specific asset. So lender has to wait of the bankruptcy proceeding or insolvency proceeding or liquidation proceeding. Suppose I have raised 20 crores from a bank in the form of an unsecured loan or unsecured debenture. In this case, if I default, the bank cannot take my office. So bank gets to plea to the court. Court will decide, and then it will actually, then if the court decides, okay, like you, so many unsecured lenders are there, all come together, and then they will be winding down the company, and then from that the payment will take place. So it is very important for unsecured lender. The recovery of money will take time. As recovery of money is taking time, the recovery amount will also go down, because when a business entity defaults, when the business entity is not doing well, if it is not doing well, as the time passes, then definitely business entities, the probability of giving back the money or probability of recovering the money will be much less. Now, there is another terminology we use called senior, another is called subordinate. What is a senior? Senior means highest order of priority of repayment. Suppose a business entity has issued 3 debentures, debenture A, debenture B, debenture C. When it says debenture A is senior most, so that means first payment commitment will happen to debenture A. Now, if it is subordinate, suppose debenture C is subordinate. If it's a subordinate debenture, it will mention with respect to what security it is subordinate. In that case, it will mention that debenture C is subordinate. It is subordinate to A and B. So that means first commitment of A and B would be paid, and B and subsequently the A, C would be paid. So that is called subordinate with the lowest order of the payment. Entity has no flexibility of repayment in the case of a debenture. Now, an entity issues 100 lakhs senior debenture, secured 10 years debenture at a coupon rate of 10% payable half yearly. What does it mean? So it means 100 lakhs, 10% per annum payable half yearly. So 100 lakhs, 10%, 10 lakhs. So 5 lakhs each every 6 months, it will make the payment to the investor or to the lender for a period of 10 years. So every 6 months, it will keep on paying that. This 10% is called coupon rate. It is nothing but interest to be paid on the face value. Now, next important point is the current liability. So what we have discussed, equity, we have discussed non-current liability. Now we shall discuss current liability. In the case of the current liability, the working capital borrowing. What does it mean? Entity takes loans or issues short-term securities to fund its working capital requirement. What is the working capital requirement? Current assets. Since I will get back the money within 12 months, so I need a fund for within 12 months. So that's why I'll issue some securities where the money will be paid within 12 months. That is called current liability. Apart from that, in the case of the current liability, something called creditor and provisions. Amounts to be paid to suppliers and services provider in future will come under the head called creditor and provisions. There is something called current maturity of term loan. What is the meaning of current liability? Current liability means any liability to be paid within 1 year would be a current liability. Now let me explain what is this component is. Suppose term loan of more than 1 year is remaining in the balance sheet. Term loan of more than 1 year remaining maturity would be having an installment to be payable within 1 year. This part will be presented here. For example, as on March 31st, 2016, the total term loan outstanding is 100 lakhs. And these 100 lakhs would be paid over a period of the 5 years. So next 1 year, the principal to be paid is 20 lakhs. And beyond 1 year is 80 lakhs. So these 100 lakhs, out of the 100 lakhs, 80 lakhs will come here. Look at this diagram. 80 lakhs will come here and 20 lakhs will come here. So please remember, the 80 lakhs would be coming as non-current liability and 20 lakhs would be shown under current liability to give the meaning that this amount would be paid within 1 year. Now, loans and advances from customers. In case it has taken as loans and advances from customers and it has to be repaid within 1 year, it would be booked as an current liability. If it is more than 1 year, it will be coming under non-current liability. So types of current liability, same secured, unsecured, senior and subordinate. Now, if you look at it, how the seniority and subordinate will change. The current liability would be senior compared to non-current liability. The non-current liability would be senior compared to equity. So senior most current liability, then non-current liability, then equity. So this is the order of preferences. The payment will take place if the company has actually gets wind up, unless it's a secured facility. Now we'll talk about the asset side. Now non-current asset we will be segregating into 2 parts, current and non-current. Non-current assets, we get it something called fixed assets. Asset used for production, example land, building, plant and machinery, etc. Next is financial assets, money given and financial securities received, and the money would be realized into cash after 1 year. Suppose I have invested in shares where I will sell it after 1 year. So in that case, it will be coming under financial assets. Now investment, entity would receive, suppose I have given 20 crores of rupees That means I means a company has given 20 crores of rupees, and against that it has got a share worth of 20 crores of rupees. When it is giving the money, at that time it will note in the document that it will hold it for more than 1 year. So that will be categorized under the head called investment. Because why? Because investment, when an entity is, listen it carefully, when an entity is giving the money, in return it is giving some financial securities which are tradable in nature. That is called investment. Now suppose I am giving the money and I am getting a share certificate. Share certificate can be sold in the market. So when share certificate is tradable in nature, that is why it is booked under the head investment. Now loans given, when entity is receiving a financial security which are not tradable, that is booked under loan. Try to understand that. If I give 20 crores, in one case, in one scenario, I am getting a share. So I will book under the head investment. In another scenario, I am getting a loan agreement which cannot be traded in the market. So in that case, I will book it under loans and advances. In both the cases, it's a non-current assets because I am investing or I am giving the money with an intention to get it back after 1 year. So again, whether it's an investment or loans and advances, it depends on the security which I am getting, whether it is tradable or non-tradable or not. Who defines it's tradable or non-tradable? Very simple. The rule of the country will define whether it's tradable or non-tradable. Now, intangible assets which are intangible in nature, telecom right, pharmaceuticals, etc. Goodwill, the goodwill of the entity due to inherent strength is the goodwill. Now, once we know the value of the assets, the prudential principle or prudent principle of accounting says that the assets should be valued at market value or cost. So once I have given the money and subsequently if the value goes down, how this is factored in? Now, in the case of the fixed assets, we use methodological depreciation. In the case of the investment, we do mark-to-market losses for investment. In the case of the loans and advances, we do the provision for bad loans for loans and advances. In the case of the intangible assets, we do the amortizations. In the case of the goodwill, it is called impairment. Since you have already covered deferred revenue expenses and etc., so you are very clear about that how these different assets are actually, the values are going down. So this gives you the meaning of assets. Next part is the current assets. A current assets means that I would be able to convert it into cash within 1 year. Now current assets, first it starts with inventory. Inventory consists of raw material, WIP, finished goods and consumable spares. All of you know why it appears on the balance sheet. If you can recollect that how it is appearing, when an entity is buying raw material for production, then raw material is appearing. When that raw material is converted into finished goods is appearing. So that is inventory. So always remember, inventory consists of 4 components: raw material, WIP, finished goods and spares. Next, receivable, the amount dues from customers. Next, loans and advances given, and where it is given and it is at the time of giving itself, it is very clear. The document says that it is to be recovered within 1 year. Then in this we booked under current assets. Advanced taxes paid, current assets. Now in this case, how to capture the reduction in the value of the assets? For the case of the receivable, if there's any reduction in the value, it would be the provision for doubtful debt for debtors and write-off for bad debtors. So debtors, sundry debtors or receivable, these are more or less same. Let me again brief a concept. Trade receivable means, suppose I am a business entity. I am selling pharmaceutical product. This is my main line of activity. I am selling on credit to X. So the money to be received from X is appear in my balance sheet is a trade receivable. Another part is that I have a premises on rent. I have given the rent to another company and the company will pay the rental after say 1 month. So in that case, it will come as a sundry debtors. So trade receivable means money to be collected due to the main operation of the business, and sundry debtors is the money to be collected in future for income, deferred income, which is not for main operation of the business. But for both the cases, if there's a doubtful that I may get, may not get, then I make a provision for doubtful debt. But if I know that, what will happen? It will be bad. So I write it off. So write off for bad debt. Please remember, write off for bad debt does not mean that I will not pursue legal action. Write off for bad debt means I am reducing, correct? I am reducing what? I am reducing the value of the assets. Write off of bad debt still gives the right of the entity to pursue the legal actions. Slight deviations. If you see recently, there are a lot of hue and cry about the written off of loan to Vijay Mallya. In that case, bank has written off the loan. If it has written off the loan, it means from the asset it is reduced. Now, if it is reduced, it does not mean that it will not pursue the legal action. So write-off would be always happening for bad debt. Doubtful debt would be provided for. So it's provision for bad debt, it never happens. It's a write-off of the bad debt. Now, mark-to-market loss for investment and provision for bad loans and advances will take place. So how to value the reduction in the value of the assets. Current investment means investment in shares, debentures, securities, mutual fund to be realized within 1 year. So now all of you know the meaning of this part. Current investment is shares and debentures. Cash and bank balance, the next part is that the bank FD, current account, and cash balance is the cash and bank balance. Now, write down of the inventory will take place in the case of the capturing of the accounts. Now, so that is that. Now, so you are very clear about now what is the different meaning of balance sheet items. Now, apart from the balance sheet and P&L, something which is appearing in notes to the account. I have shown you in previous some lectures that how the notes will appear. Notes to the account will give also certain kind of informations about the business entity. One of the important notes to the account we'll talk about is contingent liability not provided for. What is a contingent liability? Liability has not crystallized today, but in future it can happen. If it happens, then what will happen? In that case, there will be outflow of fund. Outflow of fund means credit, balance sheet, asset, bank. So second it would be debit. Debit means P&L, it will be debited. So a liability which is not happening today, but there is a possibility it can happen in future. This would be reflected in the notes to the account. So notes to the account reflects contingent liability not provided for. Had it been provided, immediately you would have passed an entry of the debit P&L expenses, contingent liability or disputed tax provided for. So first example of a contingent liability not provided for is tax dispute. Now, income tax department to collect revenues, they can send notices. Government, the business entity is protesting the notices. So it has filed an appeal. Since it's filed an appeal, so it will be appearing as a notes to the account as a disputed tax dispute. Now, why the company will not provide? The moment company provides, immediately income tax department will say that, okay, you yourself is accepted that there is a possibility of devolvement. So that's why you should be actually making a payment. So that's why, please remember, in the case of the tax dispute, company may not provide the full amount. Off balance sheet item like bank guarantee. Suppose a corporate has given a guarantee of raising the fund on behalf of another corporate. So in that case, it will come as an off balance sheet item. Similarly, derivative exposures, foreign exchange exposure will come as an off balance sheet item. Apart from that, suppose a corporate has given a commitment to the government that I will give the government of 20 crores over a period of the 5 years. That will come as a future commitment. So what we have said, notes to the account plays an important role to find out the impact which has not come in the balance sheet, but I know something which is coming on the, which may come in future. So here, what we have discussed, a complete understanding of different item of profit and loss and balance sheet, which you have been able to understand the meaning. Now, by this time, you are absolutely clear about the profit and loss balance sheet, different item, what does it mean? For the next 10 sessions or 11 sessions, you would be taking you through the application of these numbers by two important process called ratio analysis and cash flow analysis, and what are the implications. Thank you very much for watching this video.